Welcome back to Options Trading Simplified. Confused by phrases like in the money or out of the money? These terms are key to understanding option value and pricing. In this quick 2-minute video, we'll define them, show scenarios, and explain why they impact your trades. Subscribe and hit the bell if you're ready to level up your options knowledge. Let's break it down. These terms describe an option's position relative to the underlying stock's current price and its strike. In the money, ITM, means the option has intrinsic value. It's profitable to exercise now. For calls, stock price is larger than strike. For puts, stock price is less than strike. At the money, ATM, is when stock price equals the strike, neutral, no intrinsic value yet. Out of the money, OTM, has no intrinsic value, unprofitable to exercise. Calls, stock is less than strike. Puts, stock is greater than strike. Scenario 1, ITM call, stock at $120, strike $110. Intrinsic value, $10 per share. Premium might be $12, so total value reflects that profit potential. Scenario 2, ATM put, stock $50, strike $50, no intrinsic value, but time and volatility keep it priced around $2 to $3. Scenario 3, OTM call, stock $80, strike $90. Zero intrinsic, pure speculation. Cheap premium like $1, but high risk of expiring worthless. Why care? Moneyness drives pricing. ITM options are expensive due to built-in profit but safer. ATM balances cost and odds. OTM are cheap lotteries, great for big moves but often lose. It affects strategies. Buy ITM for hedges, OTM for gambles. Tip: check moneyness in your broker's chain. Recap: ITM equals valuable, ATM equals even, OTM equals hopeful. You now know your moneyness. Thumbs up if this helped, and comment a scenario you're curious about. Subscribe for more options breakdowns. See you next time.